Here we go, dead curls. We're going to practice our debits and credits, so we'll use our mnemonic dead curls to help us memorize what side is the normal increasing side for each type of account. And I think if we practice with transactions A through D in this video, just to keep it from being too long, will be sufficient enough to get the idea. So let's first get started with learning dead curls. I'm going to get rid of my video. So let's get started with one giant T. So let's draw a big T. And we're going to do our mnemonic dead curls. So let's just start with that. D, E, A, and D. And then curls, C. It's missing the U, but we'll survive. Some people teach with the U, but I don't. So we have dead curls. All right. So we have here on our left side of the T. And then we have our right side of the T. All right. And so our first D, that means that is debit. And the word debit in the language of counting only means left side. That's all it means, okay? So any other definitions that you think of for debit, erase that for accounting, because accounting just means, debit just means left side. All right, so when you think of debit card or whatever you're thinking of, that has a different meaning compared to the language accounting. And same with credit. So credit, if you're thinking of when you're at a store or something, or like, and you return something and they say, we credited your account. Yeah, different meaning, or credit cards, different meaning in language accounting. Credit just means right side. All right, so we're good there. So debit, left side, credit, right side. And now we're going to define what's on the left side and right side. So the E is our expense. So that's our accounts that are expense accounts, asset accounts, and then dividends. And if you're in college accounting, it'll be withdrawals. So for the sole proprietorship, instead of dividends, the word is withdrawals. All right, but you're going to probably move on maybe into financial accounting, so you want to know dividends as well. All right, so we have revenue for the R. Then we have liabilities. And then we have stock. All right, so common stock. And then in college accounting, it would just be the capital, that owner's capital. Okay. So this big giant T, it tells us what happens when this account's increasing, what side it's going to increase on. So I'll draw a big giant arrow for increasing. So that's all it's telling us. If we want to know if it's decreasing, then it'll just be the opposite side. So increasing, I'll write out, so in case you're writing notes. And then also it's called the normal balance. All right, so if I said what side is the normal balance side for assets, okay, well her cheat tells us it's on the left side, debit side. If I said, well, cash, what type of account is cash? Well, cash is an asset, all right? And let's say we paid out cash. So goodbye cash. Cash is going down. So cash, which is an asset account, it's decreasing. Well, what side would that be on? Well, our cheat tells us what happens if it's increasing. So we know cash would increase on the debit side. So what side would cash decrease on? The opposite side. It'll be a credit. All right, so we're going to practice with that with a few transactions. So let's go ahead and pull up our transactions. All right, so here we have some transactions to do. I wrote my cheat sheet for myself in the top right corner there for my dead curls, telling me what happens when it increases, and I know that it'll be the opposite when it decreases. So transaction A, let's get right into it. Owner A invests $6,000 in cash and $200 of office equipment into the business. So we know cash is one of the accounts affected. It's going up. We have $6,000 more in cash now in the business. Same with office equipment. We have an extra $200 worth of office equipment into the business. And then we also know that we need to reflect that this owner A has some capital. So owner's capital of $6,200. So we have 3 accounts that we need to do a T count for. Let's do some T accounts then. we'll say, okay, capital was one of them. And then we had office equipment. And then we had cash. Cash is probably going to be one we'll do a lot of, so we'll make that. All right, so we had cash. Cash, what type of account is cash? Well, it's an asset. And is cash going up? Yep, we're getting 6,000. The business has 6,000 now in cash, so it's increasing. Well, my sheet works for that. We know it's on the debit side, the left side. And I'll help you out here. I realized since we're just learning, we'll do that as well, but we call it the debit side. All right, so that's 6,000 there. And now equipment. What type of account is equipment? Well, equipment also is an asset, and so it is going up. And so it will increase also on the left side, on the debit side. And then capital. All right, well, capital is also going up now. We have to reflect that this capital account now has an additional 6,000. It looks like the business is just starting out, so now we didn't have any capital, and now we do. So we have 6,200 in capital, and we can see that capital increases on the right side. Perfect. Now we're in balance. We're happy. So if we wanted to, we can actually write this journal entry out. I'll just do this one. I'm not going to do the journal entries for the other ones. We'll just stick with the T accounts. But you can see here, this helps me do my journal entry. When we do journal entries, we always record the debits first. So in this particular, we have two debits. We have cash and office equipment. It doesn't matter which one you do first. I'm just going to do cash and then office equipment. And then we have a credit we'll indent for. We always indent out a little bit. So just a little bit of an indent there for capital, owner's capital. I was being sloppy. And so we have 6,000, we have 200 for the office equipment, and then we have the credit indented out. So that's actually our journal entry. And you can see how I used that T account to help me out. I knew that 6,000 was debit side, 200 was debit side, and then I knew to indent, and now I'll write out my credits. So I like to do the T accounts. Some books like to teach the journal entries first before the T accounts. I don't like to teach that way. I like to map it out first with my T accounts, and then I can write out my journal entry. So that is the way that I teach that. Okay, so that was transaction A, and we actually got a bonus of a journal entry with it. Let's just do the T accounts for the remaining ones so we can keep this video not too long. So let's do transaction B. So they buy office equipment for cash. So now they got office equipment for $500 worth, but they paid out cash of $500 for that office equipment. So let's start off with cash. Cash, what type of account it is? Well, it is an asset. But this DEAD CRLS tells me what happens when it's increasing. And cash, goodbye cash, we're paying out cash. So cash, the asset account is decreasing. So what is it? It's the opposite. So the opposite side, remember this tells me what happens when it's increasing. So the opposite side for cash would be the credit side. So there you go. There's my reflection of cash going goodbye. And then we got office equipment, $500 worth of office equipment as well. So office equipment is going up by $500. Okay? Perfect. So we got one debit, office equipment, and one credit, cash. So if we're writing out our journal entry, it would be office equipment, $500, and then credit for cash, $500. Next we have is transaction C. They buy an additional office, well, they're buying a lot of office equipment on account. Oh, on account this time. So no cash involved. Instead the business said, put it on my account, I'll pay you later. We don't have accounts payable here, but that would be the account for account on account. So let's just draw another T account, or I'll just draw it right here. And abbreviate it. There you go. Accounts payable now. What type of account is accounts payable? Well, that's a liability account. Let's start off with office equipment. We know we got an additional $300 worth of office equipment. Office equipment is an asset, and an asset increases on the left side. So we know it's $300 here on this side. And move that up a little slightly. And then now we have a liability account. We didn't have it before, now we do. So we need to reflect that liability account increasing. And that liability account is increasing by $300. So when a liability increases, it increases on the right side. So that is a credit. So on the credit side, so $300. So we would record that journal entry as a debit to office equipment, $300. And then we would write out accounts payable for the credit of $300. Cool. One debit, one credit. We're in balance. We're happy. As I say that, you can see here that we're also, if we backtrack to transaction A, we can see that this is a total debits of 620 as well. So we're in balance too. We have two debits and one credit. That's fine. Our two credits added up to 6,200 and equaling that credit of capital for 6,200. So as well. So you can have more than two accounts involved. Okay, let's do transaction D. Why not? A little more. So that one, they had provided consulting services for cash of $2,000. So they got cash. Yay. And they provided those services. They earned those services. So we'll have a new account called service revenue. All right. So we now can look at our sheet and we can see when we increase service revenue, that'll be on the right side for credit. So service revenue increases on the credit side. We want to reflect that we have some earned revenue, so we want to reflect that, and that's $2,000 worth. I know I started off with the harder one first, so we have our credit, and then we knew, yeah, cash is an asset, and we're getting cash, yay, so we have $2,000 here on the cash side, and we're balanced debit to cash and a credit to service revenue. Cool. Love it. Let's do one more. Let's peek at this E. Why not? We're on a roll. I promised this last one. Okay, this says they provided consulting services on account. Oh, I'm happy we did this one. It is on account. So we didn't get $3,000 of cash. We provided the services. That means we earned. Oops, let's go back. Stop moving around. We provided the services. So that was that we earned it. So we get to record our revenue for $3,000. So let's do that because we did that first last time. So why not? So $3,000 it was. Revenue was the R in DEAD CRLS. Increases on the credit side. And so we can see $3,000 there. But we didn't get cash. We didn't get the cash. It said on account. So that means the customer said to me, put it on my account. I'll pay you later. So the customer is going to hopefully pay us soon, very soon, I hope, maybe in 30 days. And so we're going to receive the cash soon. So you can see what I did there. There's this new account called as an asset. It's called accounts receivable. We're going to receive, hopefully very soon, cash, but not yet. So accounts receivable is an asset. Accounts payable, right next to it, that's a liability. Anything with the word payable, it gives it away as liability. Accounts receivable means we are going to receive. It's a liability on the customer side. They owe us money, and we're the business. We're going to receive it soon, hopefully. So again, asset going up by $3,000. So our accounts receivable asset increases on the debit side. And we can see that we are in balance because we have a debit to accounts receivable and we need a credit, right? Debits must equal credits. And there we are. Credit on the right side for service revenue. So we're in balance. So that's up to transaction E, and trying to keep this video short. And I will provide the worksheet if you want to practice the other transactions that are there as well. Okay.